And oil prices hit lowest level on Tuesday since February 2009 due to too much supply. But on Wednesday, the prices rebounded slightly in Asian markets. Analysts say the uptrend won't be sustainable.
Falling oil prices may have a deep psychological impact on the market. That's what some analysts say may be the result of oil prices sinking below $40 a barrel for the first time since February 2009. Oversupply and lack of demand continue to drive oil prices lower. The recent decision by OPEC to not cut production wasn't a surprise to many. Citigroup says Saudi's current oil policy has in part accelerated oil's collapse and driven prices far lower and for far longer than expected.
OPEC's decision to maintain their supply is what's behind the slide. And what makes it worse is that Russia hasn't cut production. The U.S. has just started to slow a little bit. And China, who's the consumer that they're all after, has become different from their stock market volatility, the currency devaluation. They already stockpiled all of the cheap oil, filling up their strategic petroleum reserves, and their economic growth is slowing.
Analysts like Citi say looking ahead to next year, a key question is, will the Saudis believe they have won in the oil wars? Citi says the Aramco CEO believes next year will be the year where imbalance in the market will adjust and stabilize, and will hopefully see an adjustment in prices.
It's hard to pick one because there's so many factors driving oil right now. Of course, OPEC's supply decisions, the geopolitical risk in the area, Chinese demand growth, the strong dollar, and even the weather. El Nino is impacting oil. One thing is that they're all impacting oil in the same way. That's down. So as the supply increases, that's negative. As Chinese demand growth decreases, that's negative. As the stronger dollar increases, that's negative. And the impact from El Nino making the weather warmer is negative because the need for heating oil is lower.
Some economists say the lack of hedging by oil producers next year and a WTI futures curve entirely below $60 a barrel leaves the Saudis with a clear incentive to keep prices low near term. U.S. oil producers are less hedged going into next year than this year, and this may prove a troubling period for U.S. shale also. Industry experts say the next OPEC meeting in June will be crucial, especially if oil prices haven't improved by then.